What is extra dividend? An extra dividend, sometimes called a special or irregular dividend, is a one-time dividend paid to a company's shareholders of record. Unlike most dividends, which are paid at regular intervals and in predetermined amounts, extra dividends are typically announced with little to no warning, are usually for significantly larger amounts, are non-recurring, and are paid in cash. Companies think carefully before they announce an extra dividend, not only because of the outlay of cash, but also because doing so may have other ramifications for the company. Breaking down extra dividend. An extra dividend is a way for a company to share a windfall of exceptional profits directly with its shareholders. An extra dividend will have the same effect as a regular dividend on the stock price, which is that on the ex-dividend date, the stock price will be reduced by the amount of dividend declared. However, because the stock price generally reflects all of the market sentiments and the price could be more or less than that amount. Typically, an extra dividend is a result of extra cash. You can think of a special dividend as one-time gift from a company to its shareholders because, for example, the company may have enjoyed strong earnings, but cash can pile up on the balance sheet for other reasons, such as the company spinning off a subsidiary, a department, or some asset, or because the firm may have won a lawsuit. Sometimes a company can issue extra dividend if it decides to change its capital structure. That is, the percentage of debt versus the percentage of equity used to finance the company. By decreasing its assets, because dividends are paid out of cash, the firm debt ratio will increase. Why would a company pay an extra dividend? A company may use extra dividends strategically to show shareholders that it is confident in its long-term prospects. For example, by declaring an extra dividend, a company also can signal to the rest of the market that its footing is sound, perhaps to gain more investors or for other reasons. But whatever the reason, the effect of an extra dividend generally serves to engender shareholders' loyalty toward the company. So an extra dividend can be a bonus result of a management strategy, or it can be part of the strategy itself. Extra dividends also can be useful for companies in cyclical industries, because these companies are affected significantly by economic changes. Their earnings are unpredictable. They might post a profit in some periods and take a loss in other periods. Hence, cyclical companies can use an extra dividend to create a hybrid payout policy. For example, they can follow the normal dividend cycle, but whenever earnings are good in a particular period, they could distribute a portion of them via the extra dividend. Why is it important to investors? Many investors purposely seek out dividend-paying stocks because they offer the added benefit of a regular income stream. Regardless of whether an investor is interested in generating income, dividends play an important role in the overall performance of any portfolio. And when an investor is looking for stock to hold for the long term, a company's willingness to pay extra dividends often signal that it is focused on stability, growth, steady management. Extra dividend in action, Microsoft Corporation. A well-known story about an extra dividend is when, on December 2nd, 2004, Microsoft paid out a special cash dividend of $3 per share for a total of $32 billion, which was worth 38 times more than its regular 8 cents per share dividend. On that day, Steve Ballmer, then Chief Executive Officer of Microsoft, received a dividend check for $1.2 billion. And Bill Gates, then co-founder and chairman of Microsoft, also got a big check of nearly $3.4 billion in dividends. These two executives made a fortune overnight because they were investors in their own company. As an investor in that scenario, imagine buying 1,000 shares in a company and getting paid 8 cents per share every quarter, which is fairly common. After a quarter, you would have made $80, and after a year, you would have gained $320, which is fairly decent. Now imagine that one of those quarterly payments was not 8 cents, but instead you received an incredible $3 per share. That one payment alone will be worth $3,000, which is like getting 9 years of dividend payments from Microsoft in one day. And while Gates and Ballmer received billions on that day in 2004, thousands of everyday investors also got checks for $1,000, $2,000, possibly even $50,000 or more simply by being invested in Microsoft. Can we cash in on a similar extra dividend today? That still might be possible with Microsoft or other companies with massive amount of cash that pay large extra dividends. But it is very difficult to find the right companies. And although extra dividends can look very appealing, there are potential downsides too. Drawbacks of extra dividends. For a company, companies might declare an extra dividend thinking that they will have enough cash to fund future projects even after paying the special dividend. But if a company's judgment is wrong, then the company can risk not being able to take advantage of future opportunities because of having distributed the extra cash, or the market could misinterpret a company's declaring a special dividend to mean that it does not have any new projects to invest in, and this perception could drag down the stock price. Investors looking for growth would not want to be associated with a company that had no reinvestment opportunity. For an investor, extra dividends are not predictable. The temporary growth in a company cash is not organic. It happens because of some special occurrence. So for a long-term investor, the extra dividend is really not that important. It has no effect or a small effect on valuation, and it is not considered in a dividend yield calculation. Moreover, when a company makes a special dividend payment, its stock price is immediately reduced by the amount of that payment. Sometimes investors will try to sell their shares after receiving a special dividend payment, but if they do, they are essentially wiping out their own profits by taking a hit on the price of their shares. Also, the more investors who try to sell following a special dividend payment, the more a company's stock price likely will drop. Avoid temptation to chase extra dividend announcements. Although special dividends are not necessarily bad, there is no evidence that they provide any long-term benefit to investors. In effect, they are neutral and sometimes can actually be negative, especially if they result in slower long-term earning powers and dividend growth. Overall, it is never a good idea to chase special dividends. Rather, it is best to stick with high-quality dividend growth stocks that have occasionally paid out an extra dividend. Just remember to always do research to make sure that you are investing in a company for a long term and one that fits your unique risk tolerance, time horizon, and financial goal.